The combination of valuation because of underperformance versus large cap over the recent past, and an interest rate environment that seems to be in a downward trajectory are both actually very positive for global smaller companies.
Hello, you're watching Proactive. Joining me in the studio today is Tarlock Randhawa. He's lead investment manager of the Jupiter Origin team at Jupiter Asset Management. Tarlock, very good to meet you.
Great to be here, thank you.
So, Tarlock, could you start by telling us about the attributes of global small caps? How do they differ from larger companies?
Well, we certainly think that there's a larger opportunity of potential price appreciation in the small cap space, and actually also the opportunity for investment managers like ourselves at the Jupiter Origin team to outperform the respective benchmark that we're measured against. Obviously, there's larger potential for growth with small cap names. They're starting from a smaller base, but you've got to make sure you buy the right stocks because there's also some big losers in there as well. But on top of that, we believe that for structural reasons and other reasons, small cap stocks tend to be undercovered. And that's partly because asset managers in general struggle to dedicate the resource that small cap stocks deserve because of hitting capacity levels relatively early on. So for us, we find that it's easier for us to find opportunities in the small cap space, but also the opportunities that we generally do find tend to have much larger upside than in the larger cap space.
What are some of the risks of investing in smaller companies, Tarlock?
Yes, well, there is no free lunch in the investment world or in the world in general. And obviously with greater potential upside comes potentially significantly higher risk at the individual stock level. And because these stocks tend to be undercovered and under-researched, it does mean that there can be significantly more stock-specific surprises, both on the upside and unfortunately also on the downside. So what that means is as you go down the cap scale, volatility in individual stocks tends to increase almost exponentially. And that's why for our portfolios that we run in the small cap space, we prefer to minimize stock-specific risk by owning a larger number of names at a smaller weight. So in our smaller company portfolio, we tend to own around 200 names in that portfolio compared to 100 stocks in our large cap portfolios.
What kind of smaller companies do you like to invest in, Tarlock?
Well, it's not smaller companies in general for us. For us at the Jupiter Origin team, we prefer a particular type of stock in all markets. And we believe that a stock that exhibits the particular characteristics that we're interested in will outperform its respective benchmark, whether it's a small cap stock or whether it's an emerging market name or whether it's a US name, for example. And so we're always trying to build portfolios that will always exhibit particular characteristics because we believe that those characteristics will lead to outperformance versus benchmarks over time. Very briefly, what those characteristics are a history of wealth creation, and so returns significantly in excess of benchmark returns. And to give you an idea of what that means in the small cap space, the average stock in our small cap portfolio is more than twice as profitable compared to the average stock in the index. We clearly don't want to pay out for that success. So at the point of purchase, the stocks that we buy will have some skepticism around them. If there wasn't skepticism, there wouldn't be a valuation gap that we would be able to exploit, and I wouldn't be sitting here today. So we want to make sure we're buying these stocks at the right price, and we also want to make sure that these stocks are going to continue being profitable in the future. So we look at expectations of future profitability to make sure that historic success is going to continue into the future. And finally, we want to buy these stocks when the rest of the market is finding them attractive as well. So we want to buy these stocks when they're already outperforming the benchmark. And so another way of thinking about what we do is we buy great stocks at great prices that are continuing to be expected to continue being great in the future. And hopefully we're buying them at the right time.
How do you find these companies? Tell us about your investment approach.
Okay, well, we start with a universe that is limited purely by market cap and by liquidity. And the reason we limit by those two measures is because we want to make sure we don't hit any capacity issues anytime soon. That results in a universe of around 5,000 stocks for us. And just to give you a comparison, the index that we measure ourselves against has around 2,500 stocks in it. So we have an investment universe of twice the number of names that are in the benchmark. And that's partly one of the reasons that we have such a high active share in our portfolios. Active share is a measure of how much or how little you overlap with the index. And our active share at the moment and historically has been over 90%. And what that means is that only 10% or less of our portfolio looks like the benchmark. Our clients are invested in active managers. They deserve an active portfolio, and that's absolutely what we deliver. We run that universe of 5,000 stocks through a mechanical screen, and that screen ranks those stocks in order of attractiveness based on the characteristics that we believe will lead to outperformance over time. And we, as fund managers, a team of 5 of us, then compare the best ideas that we're presented with to the portfolio that we currently have. And essentially, what we're doing is using our 25 years worth of experience of managing portfolios in this way, 15 of which have been in the global small cap space. And we are assessing all of the opportunities presented to us, getting rid of the stocks that no longer look like they deserve to be in the portfolio, and reinvesting into new ideas that look more compelling.
Is the current economic environment supportive for smaller companies, and how important is the economic backdrop to you as an investor?
Okay, as an investor, the economic backdrop isn't important to us. We are not macroeconomic investors in any way. We are bottom-up, stock-specific pickers of stocks. That being said, for the last 15 years that we've been running global smaller company portfolios, we've obviously been faced with very different economic environments that have been both good and bad for equity markets. Fortunately for us, we've been able to significantly outperform both the benchmark and the majority of our peers over those different economic cycles. That being said, it is at the moment a period where global smaller companies in general look very attractively valued. And that's primarily because global smaller companies on average have significantly underperformed their larger cap counterparts. And because of that, there is certainly a very large valuation gap versus small and large cap businesses. We're also in an economic environment where globally most central banks are cutting interest rates. And because smaller companies on average tend to have much larger debt levels, they're more highly levered, that tends to be a very positive economic environment for global smaller companies. So the combination of valuation because of underperformance versus large cap over the recent past, and an interest rate environment that seems to be in a downward trajectory are both actually very positive for global smaller companies.
Tarlock, could you tell us a little bit about your investment experience and how the Jupiter Origin team came together?
Okay, well, I entered the industry around 25 years ago, and I was very fortunate that my first investment management job was with the people that I'm still working with today. So 25 years ago, myself and the 2 senior members of the Origin team met and created the investment process that we continue to run today, 15 years of which have been within global smaller companies as a dedicated asset class. We're joined with another 2 members of the team, so there are 5 of us. And to overcome behavioral biases, the 5 of us genuinely work as a team. And we execute in a very rigorous, evidence-based way to create portfolios that are always strongly biased to the characteristics that we believe will lead to outperformance over time.
Tarlock, thank you very much for coming and sharing that with us. It's been a pleasure speaking.
Thank you very much. Thank you for having me.
That's Tarlock Randhawa. He is lead investment manager of the Jupiter Origin team at Jupiter Asset Management.